All right, everybody, welcome. We know we're playing in different social outlets. I don't know where you're at. If you're watching on Facebook, YouTube, LinkedIn, I have no idea. So welcome. I've got my friend Lance Lambert here. And if you know who he is, amazing. We all love him for all the data he pieces together for the industry. If you don't know him, please check out his company. It's a newsletter that provides massive information. I always push it because everyone should sign up for it. And that's ResiClub. He started this dude, is it about a year ago?
Yeah, just about a year ago, I had left Fortune magazine to launch ResiClub, and the goal is to, just be people's data-driven gateway to the U.S. housing market. So looking at it from what's happening across the country regionally, kind of piecing together some of the story and how things vary, looking at the mortgage market, home building, single-family rentals, and then just trying to get a lot of like CEOs and executives in the space to speak and share their thoughts on the industry, but really the housing market and where they see things headed.
Yeah, and no one does it like you. So thank you for taking the time to do the research, put it together, and tell the story. Because that's the part that I'm always like, okay, what's Lance? Where are we going, Lance? So thank you for that, man. Now, everyone tuning in, we're going to talk about where the market is and where Lance thinks it's heading just over the next couple of months. It's hard to tell deep into 2025. But Lance, where do you want to start with where the market is?
Yeah, I think a good place to start is always kind of looking at the active inventory data. Would you be okay if I share my screen and kind of run through the
Yeah,
latest?
please do.
Okay, let me just like size it right so I can get through here. Okay. So what we're seeing nationally, and I do this every month for my Resi Club Pro members. This is the premium audience where I get deeper into inventory data for 800 metros, 3,000 counties. And what we have seen is that over the past, since the pandemic housing boom fizzled out, and then really this past year, we've seen some of the growth in active inventory on the market. And so this isn't necessarily new listings. The number of new listings coming up for sale in the housing market is very low still because, there is a lock-in effect where a lot of people who, have that lower rate, that lower monthly payment, don't want to sell it and take a 6 or 7% rate. So the churn in the resale market is fairly low. But the active inventory is beginning to build. We're up 26% year over year for active inventory. And I think that's always something important to monitor because if you get a very sudden spike in active inventory, that can suggest a market that, is cooling down, right? Or, maybe even in some parts could, slip into some type of correction, right? And then on the flip
Mhm.
side, if active inventory is quickly draining off the market, that suggests a market where things could be overheating, right? As demand
Yep.
kind of overwhelms what's coming on and things what's on the market sells faster than what's coming on. So we've seen that steadily rise. We are still below pre-pandemic levels on a national basis for single family condo, townhomes, and co-ops, the active inventory that I measure, which subtracts pendings out. We're still 17% below November 2019 levels, but we're slowly starting to catch up.
Okay.
And I think that what that really tells us is that I think buyers in some of these resale markets have slowly gained some negotiating power, right? Especially on a relative basis, relative to what we were seeing the past few years, right? It's more balanced in some of these markets. And I think if you take a look at some of the traditional metrics for months of supply, I think it will be a little bit misleading because the traditional metrics for months of supply or if you're to 6 months, you're a balanced market, right? Over 6 months of supply, your buyer's market, under six sellers, right? I think because affordability has gotten so strained, right? And we were coming off such a very low level that some
Mhm.
markets, once they've gotten to 4 months of supply, right? They're more balanced, right? Or even some of
True.
them a little bit more buyer's market. And then for sellers, a place at three might not be a seller's market you would have expected in 2019. And I think a lot of that is this backdrop of how strained affordability has gotten. So active inventory now rising across most of the country year over year basis. Um, here it is on a metro level. And all of my maps and charts, they're all interactive where if readers click on them, they can go through and they can see like Miami uh, MSA is up 50% year over year for active inventory. There's now 44,000 active listings. A lot of that's in the condo side where there was the Surfside condo collapse 2021, killed 98 people. The state legislature in Florida decided, you know what, we need more reserves. People got to stop deferring maintenance on these old condos. And so some people are like, you know what, I'm going to offload this because special assessments coming, HOAs are rising, plus the insurance and everything else. So some of that has built up the active inventory in Miami, but there's 44,000 listings, up from 18,000 at the bottom of, or not the bottom, but at the height of the pandemic housing boom when things were really, really overheating. But we're slowly starting to see Miami-Dade get closer to where it was in 2018, 2019, when it had 49,000, 45,000 listings. And so going back, and so while active listings are rising year over year across most of the country
Mhm.
is still below pre-pandemic levels. That's particularly true in the Northeast and the most of the Midwest and a good amount of California. It's getting a little closer, but it's still a little bit down. And some pockets here and there in like places like New Mexico. And then the places where active inventory has gotten close to or above pre-pandemic levels are more likely in the Mountain West and in these Gulf states and parts of the Southwest, like Texas, parts of the Southeast, like Florida. And a lot of those pockets of the Mountain West and the Southeast, if I pulled up a map and showed you, and I don't have it at this moment, but I could dig it up. If I showed you pandemic migration, the places that saw
Mhm.
the most people coming in, it's very similar to these places that are very green now. And so
So it's
what
like opposite.
what occurred is that because they overheated so much, prices went up so much, those some of those markets got a little detached from what local incomes can actually afford, right? And so now that that migration's kind of chilled out a bit, and those markets have to rely more on their local income base, it's a little bit of a harder, it's a little bit harder for that, right? And so that's why actives have kind of built because fewer buyers can actually meet where the market has gotten to. And then the other thing that a lot of those markets have is they have a lot of, especially in places like Texas and Florida, relative to the rest of the country, they have a good amount of single family home building, right? And so the single family home builders have a couple of advantages. One, in Florida in particular, their insurance premiums could be lower, right? So that kind of gets the attention of some of the buyers who would have otherwise looked at the existing resale market. The other thing is, unlike an existing home seller who's like, my home's worth X dollar because I saw my neighbor sell it for X dollar and I'm not backing off and I have money in the bank and I can afford to wait it out, right? The builders
Mhm.
make their money on volume, right? And so they need to keep selling. And so in some of the places like Florida and Texas, in particular, Austin, Texas, where the market has turned and it's become more of a buyer's market, these
Mhm.
builders did affordability adjustments. Some of them did outright price cuts. You know, you have the mortgage rate buy downs. You know, some of that could be baked into the price, some of it could actually be net effective. But you've seen those affordability adjustments. And some of the builders, like in Austin that I talked to, they didn't cut prices necessarily now. They did it all the way back in the fall of 2022. And they just did 15, 20, 25% overnight, just met the market, right? And so over the past 2 years, with resale being at a disadvantage because sellers don't want to back off their price relative to new construction, that's made it to where some buyers are going to the new construction market versus resale and existing. And so that existing resale inventory begins to build in some of those pandemic boom towns. This is down to a metro level, same map as before. That one's at county. You can see same thing. It's really this Gulf region where things really boomed. They have a lot of single family home building, and there's the insurance shocks. And then the Northeast and Midwest and some pockets of California have still stayed fairly tight. And then I do tables like this where you can kind of see Austin. These markets are back above pre-pandemic levels, Memphis, Austin, Orlando, and then Hartford, Providence, Chicago. These are the places still really tight is how I would describe them. But in terms of prices, what you will see across the country, and you can see why I track inventory data like I do, because it does have this strong correlation with the pricing data here, where you see it's this gulf, and on the southwest side and the southeast side that's really seen the most weakness year over year. Now, we're not talking about necessarily huge drops, like New Orleans is down 3, Austin's down 3, but Austin's down 20 from peak. So Austin's actually the biggest outlier in all of housing for the past 2 years. And then you see the southwest pocket of Punta Gorda, Cape Coral, Sarasota. That's an area that has all the things that I mentioned before, where they had the overheating on prices. A lot of those were up 70%, whereas nationally we were up 40% during the pandemic housing boom. They saw the migration soar up and then kind of stabilize back. They have a lot of new construction, single family, right? They have the condo shock. Then they have a fifth thing, which is that back in September 2022, they were hit by Hurricane Ian. It didn't get talked about as much in the news as you would think about, but it was the third costliest hurricane in US history. And that damaged just enough properties, right, that go in and become active inventory, that with all the other headwinds I discussed earlier, created a greater softening there. But the Midwest and Northeast, a lot of resilience. You'll still see a lot of resilience in the Plain States. And then, Southern California and even parts in the Pacific area a bit. Now, some of these markets, -1, +1, +2, they've kind of chilled out. But I think if you asked me, what is my outlook for 2025, and I could share some of the forecasts too, and then I'll give my personal view. Let me pull up, let me see where it is.
Lance, do you also track pendings? Because I know some of these areas
I
are gone
do,
up.
but I don't share as much of it because in terms of my monthly trackers. Give me a second. I've lost oh, there it is. Okay, so here's the pricing forecast. Nationally, among the 16 that I've published so far, and I do have another 10 forecasts that I'll publish at the end of the month and have like 25 total. The average forecast expects US home prices to rise 3.5% in 2025. The historical average for home prices annual gains is 4.6%. So a little bit on the higher end. But when you look at like inflation and everything, that's really kind of on a real basis, kind of just meeting or just slightly above inflation. And right now, among current indices for 2024, we were up somewhere between 2 to 4%, looking at Case-Shiller, Zillow Home Value Index, FHFA, CoreLogic, Freddie Mac indices. And so that would kind of be in line with where we have been. The most bullish forecast is 10.8% from Apollo Group Management. I'll go ahead and just say I would be very shocked by that, because if you have 11% national appreciation, it means some markets were up 20. And so it would just be a pretty big shift from where the current environment is, right? Just like if home prices fell 5% nationally next year, that would be a really big shift from where we are in the macro picture today. So that one, that's pretty high. So then we get to AEI Housing Center. They think 5.5. Wells Fargo's 4.9. Bank of America's 4.7. And a lot of these kind of in the 3s and 4s and 2s. Zillow 2.9, CoreLogic 2.3, NAR 2. Freddie Mac is a little where they're kind of thinking really flat market. And so if you get to a place where 0.6% of the markets are up, you would probably see this market, you would start to see these red like slowly spread out, right? And some of these blues would be a little less dark. Otherwise, if you're in the 2-3 up for the next year, you're probably looking at a national map that has this level of bifurcation. Moody's minus 0.4, so pretty much flat again. And then here's just a look at those 16 that I rounded up. And I do have another 10, some groups like Redfin have now reported, and Realtor.com. And then I have like another 8 that are like proprietary, like Hunter Housing Economics Research Group, which provides a lot of research for like the institutions and home builders. I have their forecast as well. So I think where I am personally is that I would go back to this active inventory map. And my view is that I believe that come springtime, which right now we're kind of in the soft seasonal period, I think
Yeah.
that heading into the stronger seasonal period, you will see more action and appreciation in the spring, or not in in the Midwest and Northeast markets. That's where there's going to
Hmm.
be the most upward pressure. I think it'll be a little bit less appreciation there than we saw um, let me see if I can, than we saw this year. And the reason being is that active inventory was just so tight heading into 2024. Active
Hmm.
inventory is still tight in the Midwest and Northeast, but a little looser than it was heading into 2024. And then I think, my view is still based on where we have seen the active inventory run up. I still think there's, the potential for a few more markets around the Gulf to kind of slip into mild home price corrections,
Hmm.
especially like boom towns and, some of these areas that did get a lot of Airbnbs, right? And did see, zip codes that saw 100% appreciation in 14 months. Those are the places that are kind of vulnerable. But I think it's still kind of a very similar story to 2024 and 2025 when it comes to prices and the buyer seller dynamics. And if you zoom out and you look at the history of the US housing market, aside from a very few particular years where there were big shifts, usually
Hmm.
the next year looks the most similar, and you could measure this statistically speaking to the year prior. So 2014 looks the most similar to 2013 of any year. You could go back and pull out 60 of them, right? And 2024, if you statistically speaking, looks the most similar to 2023, right? Usually you see very subtle moves, and in the few outliers there being spring to summer 2022, uh,
Yeah.
spring to summer 2020, and then the shifts you saw in '07, '08. Usually you're kind of following, and housing moves very slow. I do want to show the rate forecast. I think that's really important here as well. And Tristan,
Yeah.
if you want to jump in and pull me in any other directions.
No, actually, I was going to ask about the rates because I just saw you posted that 2, 3 days ago when you gave everyone's rate, and everyone was surprised that NAR was the lowest. So,
Yeah,
I too.
I will say with the rates, is theirs came out in, I think, late October, maybe. So maybe they've shifted a little bit. But some of these groups that now have 6.3, 6.2, they were kind of close to the 5.8. And really, a lot of this is kind of the same place, right? Because even if, let's say Mortgage Bankers Association's right, and next year we average 6.4, well, there's a good chance that in a year where you average 6.4, you're going to be hitting 5.8, 6.8 at some point, and you're also probably going to be hitting 5.8 at some point. Just like this year, our range for the Mortgage News Daily average was a high of 7.52 in April,
Mm-hmm.
or maybe it was, no, I think it was April, into April, I think April 25th, and then a low of 6.11 on September 11th. So, and then we came into 2024 at like maybe a 6.7, 6.6, something like that. So
Mm-hmm.
in a year, and I think this year we might have averaged like 6.8, 6.9 for the Mortgage News Daily. So you
Okay.
still, in any given year, can have a pretty big range of outcomes at any given time. Um, I and I think there's a good amount of uncertainty here. And the biggest thing that would move rates down, and everybody talks about this, but it's so important that it's worth going over again, is really the economy and the labor market. Where if you go back to the summer, what we had occur is that the unemployment rate, which was at a cycle low of 3.4% in April 2023, it jumped up to 4.3% in summer 2024. And
Yeah, I
so
remember that.
those few reports that saw it jump quickly to 4.3, it got the attention of central banks and financial markets. And the reason being is that historically speaking, a lot of times when the unemployment rate starts to rise and then you get a jump, there's it's usually followed by more acceleration upwards. So there was kind of a fear in the summer for a bit, where it was like, oh, is the labor market about to take a shift? Right? Could we have a recession? And so that's when we saw the unemployment rate drop down, or I mean, not the unemployment rate, the average 30-year fixed mortgage rate dropped down briefly to 6.11 from Mortgage News Daily. And the Fed came out and just cut 50 basis points, not because they necessarily thought that was going to be the case, that there would be an acceleration upwards in unemployment, but really to send a message to financial markets, hey, if that were to be the case, we are here, we are ready. And this is my dual mandate tracker. And it takes a bit of time to digest this. But what it shows, and I get this, I get this from the Fed in terms of the idea of it, because this is actually one of the things that the Fed watches. It's the bullseye. It's the dual mandate bullseye. So the Fed has a dual mandate of low unemployment and also stable prices, right? So low inflation, their target's 2, and low unemployment. So this is the target. This is where they want to get to, their bullseye. And if you look at it, this is the past, I think it's the past 70 years. It's back to 1960. We are essentially in the bullseye range. We're a little bit outside of it, but if this unemployment rate were to move over here, right, we were moving up to 5. That's the environment where the Fed's focus really starts to shift from stable prices to more to the unemployment side of their mandate. And that's the environment where also the long-term rates, which the Fed doesn't set the long-term rates, the long-term rates are based on financial markets' assumption of where the economy, inflation, employment, and really the trajectory of future federal funds rates will be, right? But if you saw this unemployment rate move up quickly, the long-term rates would respond very fast and you would see mortgage rates move down. That's not where we are now. We're kind of in, maybe we're kind of moving up a little bit for unemployment rate, but it's kind of been steady lately. And what you will see on this chart, my arrows, is that here's where we were, these blue dots before COVID happened. We were actually most on target ever for the Fed's goals, right? Before the pandemic hit. We were right in the bullseye. And then the pandemic hits, and we go from here, this February 2020 dot, all the way to April 2020. You've never seen anything like that. So this blue arrow is 2 months. You go to essentially Great Depression level unemployment rate reading briefly. And then very fast in 2020, as you have the COVID-19 lockdowns, some of them, the most strict ones ease. You have the stimulus money, ultra low rates, everything, the economy begins to warm back up. And then 2021, into the summer, you're still seeing unemployment rate go down towards the Fed's target, but then inflation ticks up, right?
Yeah.
And then you get to here, which is full employment, right? The Fed's no longer worried about the employment, and then it's inflation's very high. That's a reading that's close to the 70s group over here. And so the Fed goes into the fastest rate hiking cycle in 4 decades, and we see this deceleration, or what the Fed calls disinflation, which is not deflating, but just a lower rate of inflation. And then this arrow is now we've shifted trajectories. Inflation's no longer coming down much. It's kind of just stagnating, right? A little up here in this category, a little down in this one. But this unemployment rate, this green dots this year, you're seeing those start to rise. And that's why I emphasize that this is the thing. If the rate environment were to move, we see the unemployment rate tick up more than expected.
Got it. So where do you see us? It sounds like, just from looking at all the data that you have, it sounds like it's going to be another similar year to 2024 outside of something crazy happening. Is that what you're seeing
Yeah,
too?
that's my view, right? That's not necessarily a super sexy view, right? Of, boom or bust, but it's kind of a similar environment that we've been in. Likely nationally aggregated single family home prices up a little bit. The rate environment, unless something unexpected happens to unemployment, is probably in a similar place. And if you ask me, what are the headwind, or what are the things that could get like, what would make me be wrong, right? And I think that's a place where the economists just get the macro picture of the economy wrong, right? And we were to see unemployment move up quickly, and that would could potentially create shifts in both of these buckets, where the mortgage rate could go down more than expected, and then also some of those regional markets, if they were to be hit more by the rising unemployment, some of them could be affected more than others.
Yeah, I
I
was
don't think
thinking
you're
about.
talking like GFC, but there is a vulnerability to spiking unemployment, to housing. And the reason being is that the hits from it might vary significantly across the country, like what actual sectors go in. And then the other thing is, when I run CEO surveys for Fortune magazine, which I still help out a little bit, when we survey these CEOs, they are eager to get more people back into the office. They want more people back into the office.
Yeah, I'm
And then when
seeing.
you ask workers, it's like, no, I kind of like very hybrid one day. They don't want to go in as much, right? But one thing that the executives don't have as much, and they've gained some of this, they don't have as much economic leverage, right? We had an overheating labor market. That's why these workers couldn't pull people back in 2021. Workers had the power, right? Now, if you have an environment where unemployment shoots up quickly and more people get called back into the office, people are scared. They're like, hey, I need to be in there, show up 5 days, really show I'm working hard to keep my job. What that could have happen is it could create impacts to some of these far out markets, right?
Mm,
Where the places that are really the hottest in the entire US housing market right now are
yeah,
places in Connecticut, deep into New Jersey, these places where you would never commute 5 days into Manhattan, right? Or some of these deep exurbs of DC or deep exurbs of Boston, right? And people have pushed out to those markets because they're searching for any bit of affordability they can get to get into the housing market. Well, if you have an unemployment rate shoot up quickly, those are the places that could be vulnerable. And then also, I think, some of the Zoom towns and things, places like that. I don't think it's we're not talking about like downside risk being GFC, but I think it's just worth noting like what some of the potential impacts of something like that could be.
interesting. So, what do you think, Elon and oh, geez, I'm losing Doge. All right, Doge coming in saying, "Hey, since the government is the biggest employer of the country, right, cutting a lot of these people, do you see that as a possible challenge for unemployment ticking up?"
Well, so I see it less in that lens, but so when it comes to the Trump administration, the things that could disrupt housing in a negative way, and then I'll get to the positive way. The negative could be if he goes too much down the tariffs route, right? And I think, some people run with that too much, because if you look back at what occurred during his first administration, yeah, he put higher tariffs on China, but some of these things that he did were just, ploys for negotiation and didn't actually occur, right? So if he
Yep.
goes too much down the tariffs route and it puts upward pressure on consumer prices, well, the Federal Reserve, who has a dual mandate for stable prices, that could hurt housing potentially, right? The area that could help housing here is if, and it's kind of in this Doge perspective, and so I think this part of Doge could have more impact than necessarily the one you're mentioning, although the one you're mentioning could have the most impact for the Washington, D.C. market, right? And some of these government concentrated markets. But I think if you have a place where Congress, and they have not done this in a long time, were to start to uh, change the trajectory of fiscal spending on the long-term side, right? The trajectory side, looking out. And if you create less of, these actual treasuries, right? Like you're taking on less debt, right? And there's less treasuries going into the market.
Yep.
That is a place where the financial markets could begin to lower long-term yields and mortgage rates if the expectation for future fiscal spending were to start to come down, right? And again, that doesn't necessarily mean the Doge would have to cut spending immediately, right? It doesn't necessarily mean they have to go through the government with an axe. But even if you change financial markets expectations for future spending, you can have an immediate impact in long-term rates now, because long-term rates and long-term yields are always looking out. It's not about necessarily where we are now. I mean,
Yeah.
the 10-year treasury yield right now is at 4. The federal funds rate is over 5. But the reason the 10 years down there is because the financial markets never expected us to stay at a federal funds rate of 5 long term, right? And so I think that's potentially some of the impact. But that's a lot of uncertainty, right? We don't know where fiscal spending is going to go, and Congress has a very low, um, uh, it's not like there's a very big majority in the House.
Yeah, very true. I love that, man. All right, so then you're looking at another similar market. What about sales as far as transactions for the year 2025?
Yeah,
Is
I don't have my transactions
it-
forecast up. I will say that a lot of the forecast have us in like the 4.2 million existing home sales. I
Yeah.
do have one more bearish one that's kind of like the Moody's down at like I think it's 3.839. This either way, whether it's the environment that's 3.9 or it's the environment that's 4.2 million existing home sales, for people on the ground, that's not necessarily going to feel like a huge difference, right?
Yeah.
I think where and some of these forecasters might be kind of conservative right now, right? Because they've been burnt the past couple years where they went ahead and forecasted like 4.8, 4.6, right? But
Yeah,
I think the environment where you get more existing home sales is the environment, and this is super basic, but where mortgage rates are lower than currently expected, right? Like
yeah,
if NAR were right and we were at 5.8 by the end of Q4 2025, that's probably an environment where you do have more existing home sales,
yeah.
because some of the people who are quote unquote locked in, they're having more kids, right? They're going to need more space. They might need to move to a different school district, right? And it might be that one spouse is kind of happy with the lower payment, and then the other one's like, no, we really need more space. Like, and it could become the thing with lock-in is that it's really a switching cost. And if you Google the word switching cost, it's not only the financial number, it's also the psychological side, right? And so if you have one spouse who really wants to move, that becomes a psychological cost in your relationship, right?
Mm,
And
yeah.
so I think the thing that moves existing home sales up is time, and if you could get lower rates. And the faster rates move lower, the more existing home sales you would likely get, as some of those people who have, 3%, 4% mortgage rates are like, you know what? I was never going to take on a 7, especially so quickly. But now that they're down to, 6, 5.5, and maybe I could buy it down closer to 5, maybe I make that plunge, right? And
Mhm.
so I think the two components there are if you could get rates a bit lower, and then the time, because the longer that time occurs, it changes the math of the switching cost.
It
And
does.
plus, people have time to make more money, and
Yeah.
their income can rise.
Time, and I think in just because we're in an election year, we're watching a lot of people feel like the election is done. We've been at around 6.5, 7 for a longer period of time. And now people seem to be more comfortable and at ease. At least from what we're seeing, they feel a little bit more optimistic and they understand the market we're in. What are you seeing there?
I think that could be potentially, there could be some truth to that, right? That uncertainty kind of is at play. But I think a lot of it's still, um, I think it's this affordability hit to the people who well, I think the affordability is a big part of this, right? And
Yeah.
it's not just the affordability to the buyers, it's also the affordability of the churn, which is somebody who would sell and buy something else, right? And kind of what you think of as lock-in. But I think if you zoom out, my expectation for existing home sales is really a slow grind upwards for many years. So we've kind of been in what you would consider some type of trough here, where in the second half of 2022, as mortgage rates shot up very fast, that was really when the existing home sales market was contracting, right? The
Mm.
churn of the market was coming out. Some of these buyers were pulling to the sidelines. And since then, we've really been in a similar environment since the end of 2022 to now, if you account for seasonality, of we're kind of in this trough, right? Existing home sales aren't still plummeting, they aren't shooting back. We're just kind of floating around at these low historical levels when you account for population. And so I think this is the trough. And then I think what kind of comes next is recovery. And I think it's just going to be real slow move up because even if you have rates come down some more than expected, you're still in this, there still is that affordability hit, right? For somebody selling to buy something else. And so I think it takes a long time. And if you go back and look at a similar period in time, existing home sales in 1978 and to 79, when inflation was soaring, right? And then rates were starting to move up, it took 13 years for housing to get back to that peak. Now, I'm not saying it's going to take 13 years to get back to 5.3 million existing home sales, which was 2019, but
Mhm.
getting anywhere near like 6 million, like, right? Like it's just going to take, well, I don't even think we should be
Six
discussing it.
million was nuts,
Yeah.
dude.
But but the 70s, even with all that population growth, it was still 13 years until you got back to
Yeah.
the peak.
Do you take into consideration our population growth right now for our working force and those retiring and then coming into it?
I think that that will impact churn. So if you Google Freddie Mac research silver tsunami, you will find a paper that they did earlier this year, which they were pretty much saying that there's a lot of these older Americans, right? If you look at the demographics, and over the next 10 years, as the number of deaths from this group rises, they looked at the amount of homes that would come for sale, right? And so there isn't necessarily a silver tsunami where it's a huge amount all of a sudden in like 2025, 2026, but we have already moved into the period now where the number of homes coming for sale from that category, the deaths category, is rising and is going to rise every year for the next 10 years.
What about those people that can't afford to move? So silver salami, silver salami. That was funny. Silver tsunami. What about those people that are just going to stay in place and say, hey, you know what? I just can't afford to move. What about those people? I feel like there's a lot of those, man.
Yeah, well, so that what we are seeing now already is that resale turnover in the existing market. So the number of homes in the US, existing homes that are getting sold in any given year, the past couple of years, is now at historical lows. And this lock-in effect is really just taken resale turnover to very, very low levels. Now, I think the fact that and so I think that what you will begin to see is that you might begin to see existing home sales come up a bit as the lock-in effect eases some, right? But I think what you will still begin to see, and this is really going to suck for the industry in relative to where we might have been if the pandemic had not occurred, right? And pandemic economics and the fiscal, monetary, all of that response did not occur. I think what you are going to see is that average tenure of home ownership in the country is going to rise. And so there will be transactions in the existing and resale market that never occur just because we went through this particular environment that created such acute a lock-in effect. And so
Yeah.
average tenure of homeowners is not a fixed thing. It can change over time. And there are different types of lock-in effects you can have. You can have what you have in California, which is a property tax lock-in, where the longer the person stays tenured, there's even more incentive to stay longer, right? As
Mhm.
your property taxes don't continue to rise. There are lock-in effects from being underwater, right? Where
Yeah.
there's this, you don't want to. So you actually saw average home year tenure in some of these markets from the after effects of GFC rise because people, the ones who didn't foreclose stayed longer. Many of them couldn't sell. or they couldn't get back to the price that they needed to sell. And there was also a psychological effect where their house used to be worth this, they're not taking less than this. And so I think we're going to see average uh, homeowner tenure begin to creep up in some of these markets.
Yeah. Unless you see rates drop for some reason, like unemployment shoots up, rates drop, like NAR says 5.8, maybe even 5.5, then the wave of people coming in with a lot more to sell because they can go somewhere. That could change the
Yeah.
market.
Well, there's definitely pent up churn where, you could even see an environment where, maybe we go into an unexpected recession, unemployment rate ticks up faster than expected, and you actually see more existing home sales because there is so much of this churn that's locked out. And, even if unemployment were to, and now this could vary depending on what type of recession we're talking about.
Mhm.
But even if unemployment shoots up from where we are now to, let's say, 6.5 very quickly, there's still a lot of people who would be employed, right? That might be interested in, selling to buy something else, who've just kind of really been sidelined the past couple of years. But that gets us back into the speculation side of it, right? And whereas if you look at the backdrop of where the economy has been so far, we've been fairly steady. And so until something there shifts, we're kind of in the place that we are, which is a place with strained affordability, a place with low national appreciation, mortgage rates kind of in that 6-ish range,
Yeah.
uh, and low unemployment.
All right, a couple of questions for you. One you touched on a little bit, Lance. It was the tariffs, but it's from Joe. What's up, Joe? How could the tariffs affect the housing market with that affecting costs of good and overall affordability if they come?
How could they
Yeah,
affect the housing if they don't affect consumer prices?
yeah. If they affect
Oh, if
costs of goods and
yes.
overall, because
Hmm.
now I'm worried about everything else, I can't necessarily afford housing as well on top of
Yeah.
everything.
Well, so I think how it could affect housing is that we are already in a place where the inflationary rate on a 12-month basis is above the Fed's target, right? Now we're kind of closer to the target, right? We're, in this 2 to 3 range, but the Fed's going to have trouble getting it under 2, right? So if the tariffs were to come into play, and even if they aren't, and let's say they go, they're bigger than expected. They're kind of more, closer to rhetoric. And that puts upward pressure on consumer prices. Well, the Fed is already in a place where they're concerned about inflation. And so if it makes it even harder to get to the Fed's target and the long-term rates are like, you know what, we're going to have higher rates for longer looking out, that's an environment where mortgage rates could maybe even go up or stay at a higher level than they otherwise would have. So I think that's, the potential impact on that side of it. But the thing about housing is that a lot of the things in the news, I would say 95% of them, at the end, they
Mhm.
have almost no effect on housing, very little, right? Like you're always seeing headlines of this thing happens. And so they're speculating, how does that impact housing? But that doesn't mean that there can't be things that impact housing that happen in the world, right? And the greatest example uh, of our lifetime is essentially COVID, right? Where that particular thing and that set of events that it set off had a dramatic impact for housing. But I think it's 95% have very little, and then it's kind of the five where, depending on how they, you know, transpire and play out can.
Okay. And then last question for you here. Craig's got a good one. I've seen stats that even though household formations continue, they've slowed greatly over the past 5 years, which impacts demand, right? Question mark.
Yeah, so we've seen a bit of volatility there, and then another thing with this data is that, there's a few different sources. There's proprietary, there's the public census, but essentially what we saw is that during the pandemic housing boom, one of the things that helped overheat prices is there was an increase in not just housing demand, which happened for many different reasons, the ultra low rates, stimulus. There was also the increase in demand for space. So even, there was the work from home effect where a lot of people were using work from home arbitrage. They had higher incomes in San Francisco, Seattle, New York, and moved to some of these markets where they could get a bigger bang for their buck. But even in the markets that did not, or that saw falling population from people moving out, like San Francisco, they actually saw an increase in demand for space, even with the loss of population. And the reason is there was an increase in household formation as, like roommates decoupled. They were both working from home, or they were both working in the office before, then they're both working from home. They're like, you know what? I can't stand being around you for 10 hours a day. I'm out. And then you also had, the stimulus money and all of that, and a run up in asset prices, which then some of the people maybe living with their parents are like, you know what? I'm ready to go on my own. And so there was an increase in household formation during the pandemic. And then there was a period where that kind of slowed down, right? Because some of that household formation that occurred during the pandemic um, was essentially a pull ahead from the future, right? Where it was like
Yeah.
those formations that were going to happen anyway in 2023, right? Or in 2024 or 2022. And they just happened to happen in 2020, 2021 because of the circumstances. But in terms of like household formation and its trajectory, I think long term looking out, you're in a place, and let me pull this up because it's better to let the chart do the talking than me sometimes.
Yeah, then you can just interpret it, which is great.
Yeah. So we are in a place where there are 18 million fewer people in the country than census projected in 2008. Uh,
Wow.
and what has occurred is that, and I'll show, here's the census. The census does this every like 5 years, their trajectory out for population.
Mhm.
And back in 2008, they expected us to be um, like 430, 440 million by almost 2050, right? And now they're saying that they think that's just going to be like 360 million people.
Oh,
And so the trajectory for census continues to come down. And what's interesting is that this has continued to come down despite immigration in some of these years being higher than expected, right? And we just saw a burst the past couple, although that's beginning to decelerate. What has occurred is that the birth rates in the US, and this is true across developed countries, are decelerating faster than expectations. And so we now will be, and let me try to find this. Um, by 2038, US deaths will start to exceed native births. So all of the population growth in the US from here through the rest of the century, this
hmm.
bit of growth, which isn't a ton, would come from immigration. And then by 2081, the US population at its current trajectory would begin to decline. And so it doesn't, the news articles don't necessarily haven't framed this that great over the past 15, 16 years, but there
Hmm.
has been a pretty big shift in the US birth rate,
Interesting. All we hear though is Elon
fertility
keep on
rate.
saying we have to have babies. Have babies. Have babies. That's what I
Yeah,
keep hearing.
so the more people and the more births that the US has, that's better for housing, especially home construction, overall sales, everything. Um,
Yeah,
Long.
well, we have people to sell. Dude, without an audience, we have nothing, right? It's like let's get busier. Lance, thank you so much for doing this, man. I always love to studying your charts, so continue to do amazing work for our industry. You are appreciated, just in case people don't tell you enough. So thank you for this. And everyone, please do yourselves a favor and jump into ResiClub. I'm going to grab the link again. James was putting it out a few times. Let me
And
put
then
it,
if anybody wants to reach me, you can email me at lance@resiclubanalytics.com.
Lance at ResiClub Analytics.
.com.
All right, there you go. Put it in there and let me stop the share just so we got you. Lance, thanks again, man. Appreciate you.
Yeah. Thanks for having me.
Everyone else, thanks for jumping on.